Hey guys, it's Steven here. This video will be on a selling option strategy for beginners, the ultimate guide to selling options for profit. I'm going to talk about what makes option selling profitable in detail and how to increase your returns selling them. It doesn't matter which brokerage you use. My goal is for this video to help you understand options a bit better and make some profitable decisions in the future. I also give an example of a tool you can use to help you analyze the price of options. I will try to make theta and options easier to understand by relating it to real estate and moving one step at a time. So don't worry if you don't completely understand options Greeks at this time. I own a few properties as a part of my overall portfolio, so I find relating examples to real estate can make things easier to understand. If you have any questions, leave a comment. I read all of them. I'll also leave links in the comments for how to sell a covered call and cash secured put, two of the most popular income generating option strategies. Let's dive in the world of theta and options trading. Theta is a feature of an option, plain and simple. Imagine showing someone a house and saying to them, it's 3 bedrooms, 2 bathrooms, in a good neighborhood, and the rent is $2,000 a month. Each thing I listed is a feature of the house. You wouldn't say that the house is good or bad just because of the number of bedrooms or because of the rent. It's the overall view with all things considered. In the same sense, this is how we should view theta, gamma, vega, delta, and the Greeks. These are just features of an option. Inherently, they aren't good or bad. They just tell you about the option you're looking at. Think of theta as rent. If options were a house, theta would be the rent. Think about it like this. Someone pays rent to get access to the house. In the option space, someone pays theta for access to other features of the option. Can you guess what they are paying for access to? If you guessed gamma, you are correct. Traders pay theta to get access to gamma. One man's theta is another's gamma. The easy way to think about gamma is that it's your sensitivity to big moves. If a stock moves like crazy, the option buyer makes some bank. Money, right? So why on earth would anyone sell options? Going back to our house example. If you wanted to buy a big penthouse in downtown New York, the rent is probably pretty high. It's because you get access to some awesome view, convenience, a prime location if you pay for it. It wouldn't make sense for the rent to be $500 a month. No one would rent it out. The rent is correlated with the house you get exposure to. In the option space, if a stock has a lot of gamma risk, aka the risk of a big move, the theta on the option is higher as well. The amount of theta is directly correlated with the gamma risk. This is because if it were not proportionally higher, no one would be a seller and there would be no market. Now here's the key. If gamma and theta were perfectly even and markets were totally efficient, the expected value would be 0. You wouldn't make money being a buyer or seller. In this world, who wouldn't want to break even with exposure to big moves? It becomes basically a free hedge. But there's this little thing called variance risk premium. The variance risk premium is a small edge for the option seller that they get for holding the risk of big moves. Because of this, on average, selling options is profitable. Option sellers get a small premium for being on the short side of convexity. In the long run, you have a lot of small winners and the occasional big loser. This is called a short volume strategy. You can see the risk premium on a lot of stocks. An easy way to see it is to plot the implied volatility for 30-day options over the realized volatility for a 30-day period. You should see that on average, the implied move, what the options say will happen, is a bit higher than what actually does. This is the premium. And then you will see periods where the big gamma move happens and the realized value goes higher than the implied value. This is why the premium exists. The green line is implied volatility. Blue line is realized volatility. This is on SPY. You can see how most of the time implied volatility is greater than realized volatility. However, the realized volatility shoots up on occasion. That is the risk we take when selling, while we get paid a premium. But here's the thing, how much can we really expect to make here? In the long run, it is about 11% per year. Is that a reasonable return? Absolutely. But we are greedy. We want more, you want more. We want more than 11% per year. So how do we do it? Let's go back to our house example one more time. Imagine we are evaluating a property in New York City. All of a sudden, a huge amount of demand comes into the market. There's a shortage of houses for all the renters, so the rent keeps increasing. You look at your property, 2 beds, nice view, fair rent is probably around $4,000 a month. But you look at the market and people are offering $6,000 a month for your property. In this case, by renting out your property, you're making an inflated premium or a rent premium higher than what you should be making with the asset you are giving someone access to. In options, we can find stocks where the theta is higher than it should be, given the gamma we give someone exposure to. Think about some of these meme stocks as an example. So many buyers, so few sellers. Who wants that risk, right? Well, this is perhaps the opportunity. If we can come into the market and put a fair value on the gamma, we can find times where we can be overcompensated with theta. There's a simple formula for understanding this. If implied volatility is higher than what you think realized volatility will be, sell. Even more simply put, if options are more expensive than how much stocks move, sell. The hard part is learning the price volatility of options. If you're interested in learning about this, leave a comment down below and I may cover this in a later video. Here's an example of how I analyze price, gamma, and theta. Imagine we divided the implied volatility by the realized volatility. We would see how much higher or lower the implied volatility is compared to the realized volatility. If the implied volatility over realized volatility is 1.5, then the price of the option is 1.5 times higher than the value the buyer is actually getting. This is an easy way to think about it. By plotting the implied volatility over realized volatility ratio historically, we can see how much of a premium there typically is and how bad it gets when the big gamma move happens. For example, typically the implied volatility over realized volatility ratio for 30 days to expiration options is positive on SPY. But we do have periods of pain where it goes lower and that erases a lot of gains. So what is our conclusion? Theta is not free money, although some people will say it is free money until it isn't. It's a characteristic of an option. Understanding it is important, but really it's our ability to price risk that makes us money as traders. The better we get at pricing risk, the truly juicier premiums we can find. Hopefully this video helped you understand selling options and theta a little bit better. If you enjoyed this type of video, hit that like button and let me know in the comments below. You guys have a great one.